Hey everyone, Matt Snow from Upstart with another episode of Leaders in Lending, live from CBA 2025 here in Orlando. Today I'm joined with Dennis and Wei from Oliver Wyman and Kurt from Pinwheel. Thank you guys for joining.
Thanks for having us.
Yeah, absolutely. Maybe we can go down the line with quick introductions. Tell me a little bit about what you're doing today.
Yeah, my name is Dennis Chira. I'm a principal in our retail and business banking practice at Oliver Wyman. I focus primarily on consumer financial needs as well as deposits.
And my name is Wei Key. I'm a partner with Oliver Wyman retail business banking practice. I do a lot of work on product proposition, innovation, pricing, sales, marketing.
And I'm Kurt Lin. I'm co-founder and CEO of a company called Pinwheel. We help build software to make it easy for banks to win and establish primacy. So things like making it easy to switch your direct deposit, help manage your bills, eventually switch your bills, et cetera, et cetera.
Great. And so I sat in on a session earlier, the three of you were a part of, in terms of primacy and defining that and in how it's important and how to help banks establish that. So I was thinking, maybe I'll start a little bit more provocative and like, is primacy even important today? If you think about open banking and the choice consumers have, like, is that still a goal worth pursuing for a financial institution?
I mean, I'm happy to start on that one. I think that's a really fair and important question. And I think the answer generally is yes, but then it also depends, right? I think there's an option where you don't need that relationship, right? Where instead you just focus on as cost effectively as possible selling a particular product, but then you become a pure commodity. And I think that the real question when it comes to primacy is how much of the value do you want to actually create that is not simply about a commodity? How much of it's actually about serving the needs of a consumer more holistically? How much of it's about your brand, about basically your values, about other things that you provide to the customer, wherein the decision of whether or not to choose to work with you isn't just about the price, it's about something else.
Yeah, fair.
Yeah, but I think there's a math question here because Dennis in the earlier session was mentioning that maybe like 97% of the Americans are actually banked. So at the end of the day, the banks are out there and the fintechs out there essentially stealing each other's clients, and primacy is a way of deepening that relationship, and really, that's what's probably going to fuel the growth going forward.
Yep. I think it's hugely important. And the way I think about it is you're trying to build a relationship with that customer and ultimately get them deeper and deeper into your ecosystem, right? So the example I always give, I think actually Dennis had mentioned earlier, is you look at Apple, right? Like maybe you start with an iPod or an iPhone, and then you eventually, you get a MacBook, then you get some AirPods, and all of a sudden, like you're in this ecosystem where everything works fluidly because you've really like bought into the brand ethos and the product suite. And as a bank, like it's a lot easier, what should be a lot easier, I should say, if you have a credit card, a checking account, a savings account, hopefully maybe with a brokerage or something, all with the same FI, instead of having one of those at 4 different places, because then they can really understand your holistic financial life and serve you better.
Sure. Yeah, and that really resonated with me, along with many stats in the presentation, but thinking about the reduction in the number of banks. So if there's so much fewer banks today, and consumers have choice, like what do they differentiate on besides yield? Like that's what consumers tend to shop, or like what are the other tangible things could a bank set itself apart to establish that primacy with a customer?
Yeah, I can go first. I think it's largely what we talked about at the end of the session, which was when you think about how you really differentiate, you really have to think about how do I create a 2x, 5x, 10x better banking experience for that consumer. The reality is banking looks very commoditized these days, right? Like per your point, unless you're like really price sensitive to, I want to maximize my savings yield, or I want to get, the most amount of points for a certain spend category. The reality is like when you can have a fundamentally different product, people get really excited, right? So one thing that, we focus a lot on is this idea of bill and subscription management, right? Can I build a whole experience that, helps the customer understand what all my bills are, like find ones that I didn't realize I was paying for, help me consolidate or find a better rate for something that I already, buy, and then kind of curate something that like nobody else is really able to do effectively. If you can do that and find those moments to make that happen, then I think you can really win.
Yeah, and you mentioned the like mobile check deposit. Like that was the last major thing I even remember as a consumer. Like this changes how I think about banking. But so would you say technology like what Pinwheel's developing, or the things you talked about, switching deposits, does that make a bank stickier, or does that just make it easier for people to switch and maybe, decrease again the need for primacy?
Yeah, so I think of it as 2 classes of products. I think one is around customer activation and portability. That's things like a direct deposit switch or, switching your card on file, right? Those things are inherently in service of making it easy to switch and make your account more portable. Those I think will, and hopefully it's a good thing that you're increasing competition, right? So that people aren't stuck at the same place because there's just like inertia of not wanting to switch, right? Even though they know there's a better product out there. And the other part is what I would call like more value creation. So like a subscription or bill manager that really helps you get a hold of your financial life, track all your bills, be able to pay them appropriately so you avoid late fees and what have you. That I think is like something that everybody should have. And it doesn't really make it, make you want to necessarily hop from one place to another place. It's just something that every single FI should have in their banking experience.
Yeah, and you guys mentioned some stats around, why would people switch primary financial institution, and it seemed to be between, major life events or just being so disgruntled, you're like, I never want to do business with this company again. Maybe like double click into that a little bit. What are some of those underlying causes of switching?
I mean, I think that the reality is when it comes to kind of the quote unquote primary checking account, the one where your income comes into and where you spend, there is a high level of stickiness there because it's sort of like electricity. You need it. You can't turn it off, right? You need to have it on. So there's a hesitancy to move that because, there's friction. But, as Kurt mentioned, a lot of the technology that we see today is actually reducing that friction, making it easier to move so that people, have more choice. But at the same time, it isn't that important for most people. They're not thinking about it regularly. And I think the real challenge that the industry is facing in a sense is this idea where, well, historically, we always focus on acquisition. Let's get the next account, let's grow, right? But then I think there's a shift right now from, focusing on quantity to quality, because quantity is churn mostly. As Wei mentioned, 97% of Americans are banked, right? And so if you want to win next customer, you have to take it from someone else. And the challenging part right now is to date, because of the way like a lot of large banks or banks in general are structured, like everything, all the business kind of product lines are pretty independent. And so you as a consumer, there's limited actual value in terms of consolidating, right? Why go to the same place when you see over there's an offer over there, an offer over there? And so people tend to go in that direction. But I think that's actually to the detriment of both the individual consumer and also to the provider, because there's a lot of waste is the short of it.
Yeah. And the other thing that struck me, you talked about, the goal should be, again, focused back on the consumer. So how do you become top of mind or that person they go to for advice? And it got me thinking, again, like, I tend to reach for my phone. So like, is the phone the new branch? So I have a question, I go to Perplexity. Like I want to move money, like I open a certain app. I want to transfer money or pay someone back for a Broadway show ticket, like I use a different app. But like the phone is like where I go first. And, is that what people expect to interact with? Or how do you think about, who is the consumer asking questions when it comes to their finances? And is that still a traditional bank, or who has that right for the consumer?
So, if we unpack a little bit your question, I think there are a few things. One is we know we've actually, as a firm, we published some research on the Gen Z population. Interestingly, we found in that research that the Gen Z, they don't respect, sort of authoritative figures and experts and such. Like, so they don't want to listen to like the person that supposedly has the correct knowledge, right? So instead, they listen to their peers, right? So they go on TikTok, and if there's an influencer, so I think we should, as financial institutions, like kind of marketing to the next generation of customers, that is important, whether you're a bank or a fintech, and just recognizing, that they actually, sort of almost like a peer pressure in some, like, there's the peer influence, right, for how they actually make their financial decisions, and that's important. The other thing I want to call out is the sort of the digital experience side of things, like because you were mentioning the phone, and if you pull up your mobile banking app, 99% of the time it shows you a laundry list of accounts, and so from a behavioral science angle, if you see the accounts, you basically are checking balances, and that's sort of the most sort of engaging thing that you could do with anybody's banking app today. But Kurt was mentioning that there's other ways of engaging with the customers that might actually get to a better definition of primacy, because just checking your accounts is not really primacy. It's a very passive sort of activity to do, right? So I think a lot of the banks actually overlook, how they actually serve their customers in the digital world.
Yeah, that's a great point. And you guys also hit on maybe an appropriate balance of that in the industry is risk management. So, how do you think about the view there in terms of, yes, be innovative, find ways to connect with your customers, but knowing that, the health of the American economy is like underpinned by this industry?
that's certainly the foundation of banking, right? This is to gather deposits is a privilege, right? You need a charter to do it. It's considered to be basically a public good in many ways, and so I think on that end, that needs to stay, right? And this industry is unique relative to all industries because of that. But that is not to say that there is not a better way to serve consumers. And I think that the challenge has a little bit been that it is expensive to basically take that next step, right? I think there's a focus on, how do I drive incremental like kind of progress in the near term? And there are some of these things that we're talking about here that are more forward looking in terms of like, what are the needs that are unmet right now that I think that a lot of consumers actually want, right? Because I think that if you ask consumers, are they satisfied with what they have? Yeah, actually they are generally satisfied. That's why they're not moving too much. But do they actually do a bunch of things in order to just kind of curate their needs, like pick a little bit of account here and account there, mix it together, and serve their needs maybe as a household of couples, for instance? Like, yeah, plenty of people do that, and what that really reflects is that actually there's stuff that people are doing that they would love to have streamlined for them if possible, right? Why not do one-stop shop? Like if you're able to actually do that in a way that creates more value for the customer, I actually think that there would be demand for that, right?
Building off of that, like to your earlier question around like, is your phone the new branch, right? There's this thesis that's existed for a long time in the industry around like building super apps, right? Like in China, there's all these examples of like, there's one app that does everything for you, right? And the fundamental like crux of it actually makes a ton of sense, right? Like whether it was Mint or all these like first wave PFMs, everybody would love to see a view of like my holistic financial life in one app, right? Like my savings accounts, my brokerage accounts, all my investment accounts, my crypto accounts. Like I want to see everything in one place. And ideally it's like constantly helping me make more money, make smarter decisions, etc. Right? So like, I don't think anybody disagrees with that dream, but I think the problem is, going back to your question, a lot of the large FIs are structured to be risk management apparatuses, right? And rightfully so, right? Like when you are relied upon for society to operate, you really can't screw things up, right? Like the cost of that is extremely high. So they're doing what they're supposed to be doing. But the downside of that is you don't have a culture of people that are willing to take risks, because like if you just don't mess anything up, you keep your job, everybody wins. You take risks, they don't work out, you create like undue exposure, things fall apart, people get in trouble. And so I think what you see is like, that's why fintech exists. That's why companies like us exist, because we can be that extended arm that helps you innovate, prove things out. And if it really works well, you can always bring it inside, right? So like the example I always like to share is like when you look at P2P payments, right? There's Venmo, there's Cash App, and they crushed for a long time. And then the banks were like, wait a second, like we should just create our own system, right? And thus Zelle was born. And like Zelle does a ton of volume. People don't even realize how much it proliferates. And it's in every bank's app for the most part, right? And so I think like if you can really prove something that works well, it will eventually get adopted by large FIs. And then like if you keep doing that thing over and over and over again, if you get another version of a Zelle or a 10x better bill pay thing or what have you, eventually I do think these large FIs will start to be super apps. But it's just going to take a very long time because no one internally is innovating at the speed they need to.
Yeah. Well, and you guys did a good job also managing like the the economic side of the equation, right? Because the cost of deposits is what fuels a lot of the ability to lend, right? So I think a lot of other technology companies, maybe the expense is different. Do you see that always being a part of the equation here? Or again, we've kind of gone back and forth in separating what should a bank do, what kind of businesses should it be in, and separating those things and regulation playing a part. Like is deposits always going to be the best way to fund, lending? Or do you see banks separating? And as you were saying earlier, like maybe there's some commoditization necessary and someone's just really good at doing a certain lending product, or someone's great at savings, and the market starts to break apart. Or banks going to stay as the super app that you're talking about?
I mean, I guess I don't know if I fully understand the question, but I mean, certainly there's, I think one of the main challenges in banking, right? That's like kind of like the ironies, if you will, is that a lot of the value that's created is through inertia, right? Like when we think about deposits, for instance, like why is there so much value is created from deposits? Why? Because it's a lower cost of funds for the rest of the bank, right? It funds the balance sheet. That otherwise, if they had to get through wholesale funding, would be really expensive. But there's this question also fundamentally is like, is that actually the right thing to do, right? And so, I mean, you look at some of the lawsuits in the last year, right, on this topic. I won't name names, but right, like the idea where, hey, consumer was misled in terms of the rate that they were going to get in their deposits. They should have gotten more. Look at that big gap. Well, you can make that argument for a lot of institutions where, like people are being paid like low interest rates on their savings, but there's like that moves, right? And what drives that inertia? And then one of the things technology has done, of course, is create this kind of more less information asymmetry. More people are aware of and easily aware of what that information is. And so, like, should that happen? Right. On the flip side, like from a regulatory standpoint, right, like that's not great for consumers, but from a regulatory standpoint, you want kind of those balances to be kind of lower cost and stable at least, right? And so it's a tricky thing in terms of what the right balance is, but I definitely see a shift inevitably where that inertia, in a sense, is like kind of similar to that anchoring analogy that I brought up during the session, where I think that anchor is getting lighter and lighter, right? Like there's just more, you have to do more than that. You can't just rely on inertia in the future.
Yeah, no, and I think you hit to the heart of the question, because the other part of that is, the focus on fees, right? So if banks fundamentally have to earn less money on fees, like the only other way, to do that is through deposits.
Or it can be through other things, I think, because there is a question as, are people willing to pay fees for other kind of sources of value? Like that's the real question, and we can say what we want about the last kind of administration in terms of, questions around fees, but like, there was a concerted push for, pushing for innovation in a sense where it's like, you cannot, in a sense, still generate as much value from kind of history. You need to create new value, right, to continue to do that. And that's the real tough part where it's like, are people going to be willing to pay? What are the people willing to pay for? Right? Because once something's free, it's very hard to, charge them for it.
Yeah, but just on that note, what's interesting is if you look at the difference between neobanks and fintechs versus traditional banks, in Chime, which is an example that's been brought up, I mean, they were one of the first to charge a monthly fee, and people are willing to pay for it. And at the time, they didn't really offer, high interest or whatnot. Like it was like the whole value proposition was, basically to advance the paycheck, and that's something that people needed, and then they were actually willing to pay a fee for. Whereas if you look at a big bank, it's a different sort of starting point where the majority of the fees are not the monthly fees, but rather, overdraft and some of the other, kind of the fees that are, in the previous administration had termed as more nuisance fees. And so I would say like the starting points are different, and the economics model is actually different between the bank side and the fintech side. And it's actually pretty exciting to see what kind of solutions they come up with. And in the session earlier, we said there was no unified. It's not like the whole industry is converging to one model of like here's one proposition to drive primacy, that the fintechs are actually coming up with different solutions from the banks. Even within the banks, they're coming up with different solutions. Right.
Gotcha.
Yeah.
This is a really key point I just want to make sure that we like hit, which is like, the banks are like the OG subscription products. People don't realize it, but like they'd always charge you monthly fees.
Yeah.
It was, you just didn't know it because it just like plopped into your transaction like flow one day. You're like, oh, it was $10 this month, right? But like nobody really thought about it because when you were at the branch, everyone like, by the way, we're going to charge you $10 to service the account, right? You just like got charged. But like they've had subscriptions for a very, very long time. And the difference that Wei is saying, which is really important, is like there's two kinds of fees, right? There's fees that penalize you, and then there are fees that like are value supported, right?
Features that you're paying for, that you want.
Right. And like
the challenge though is that like because of free checking historically in the United States, right, the expectation today from a lot of consumers that like, oh, there's a fee, but I'm gonna, that's gonna get waived. And that is true for the majority of large banks, right? It's like a small percentage, at least in the US, actually get charged that fee. And so like that's the part that's tricky, where I think that there are very few people in America today that are willing to pay for those very basic kind of services anymore, because they believe that should be free, just as free trading is free now. So the only way to be able to charge fees where it's like more like a subscription model, right, or a membership model, is like you got to give them something else, right? And the real question is, what could that be, right? And I think that in the credit card world, you see some of what that might look like, right? Some of the large credit card issuers, like they have certain models where, hey, fees are part of like the thing, and many of them have really tried to branch out where they're not just doing credit card anymore. They have savings accounts, they have checking accounts, and they're also doing the same thing as everyone else is doing, which is trying to build that holistic relationship, right? Because there's a lot of value there.
But there is this like concept that has been around for decades, like value added checking accounts, or like premium checking accounts, where you pay for a higher tier and or you pay a higher monthly fee in order to get more products, right? And so those perform extremely well, right? Whether it's getting access to like better interest rates, or like you bundle in like ID theft protection, phone insurance, pet insurance, like AAA, et cetera, right? Like when you bundle it into the checking account and you start to charge them, $10 a month instead of $3 a month, the consumer is like, actually, the math makes sense. If I don't have to pay for AAA somewhere else, is like still a good deal for me. Yes, I'll do this, right? And so there's actually plenty of ways that are good for the consumer, good for the FI, good for the ecosystem, where you can still charge the consumer fees. And I think we have to get away from this idea of like fees are bad. It's just like the fees have to be worth it to pay, right? Like you pay for Amazon Prime, nobody bats an eye at them. It's like $40 a month. You're like, yeah, because I get my package tomorrow, right? It's like I'm totally worth it.
Yeah, totally. Well, I think we're running out of time, so maybe we can end with, a bold prediction, or like if we were to meet again in 5 to 10 years, like who will be the winner in the primary financial institution race, or a characteristic of that institution? Like what will have they gotten right?
I mean, I think that scale does matter in this space, right? So I think the scale players have a big advantage here, and that scale maybe in terms of traditional banks, but also scale in terms of non-banks as well. That's the country is overbanked at the end of the day in many ways, and so that's going to make a big difference, I think.
So whoever can make the most of the customer base they have and sustain.
Yeah, and I think the number of banks will continue to decline and credit unions will decline. That's sort of inevitable, and so I think we'll see basically scale players really try to win basically a bigger share of their customers' wallet. Yeah.
While I agree with that point, I am actually pretty excited with the way open banking is headed in this country, because unlike other jurisdictions like Europe and Canada, UK, where open banking was sort of pushed by regulators as more of a transparency, like kind of data sharing kind of a mandate, there's a lot of innovation happening in the US. For better or worse, there is a lack of a mandate from the government to do things. And what that actually creates is, as traditional financial services players continue to commoditize their products, the technology players can come in to create that customer experience. And that's where the primacy, question will be answered. And I think, maybe 5 to 10 years down the road, we'll start to see true disintermediation, where the traditional players are still there to do the risk management stuff, but the customer experience and where the mind share is, where customers actually turn to, is where the technology innovators are.
My hot take, and it's definitely a hot take, is that I think the big brands that have a lot of brand equity with their customers will become increasingly more like perceived as a financial service provider. So I'll give you a couple examples, right? Like the amount of spend on Delta's American Express card is like equal to 1% of the country's GDP. It's crazy, right? And that's like co-branded card. And so you see this massive movement now of like, if as a brand I can monetize on my customer because of my relationship with them and they trust me, I can get some of that interchange. It's a big revenue stream for me, right? Like you start to see a lot of other brands trying to replicate that model because they're like, well, if Delta can do it, why can't I do that, right? And the other one is like, we just announced a partnership with DoorDash where they're basically trying to take all of their Dashers and like create a bank and a whole set of like financial services dedicated to what they need, which is not the same thing as what a Chase can provide, for example, right? And so I think whether it's because you have a special like set of data and ways to like understand your customer, or you're just a brand that has I don't understand why Airbnb or Nike or some of these brands that have a lot of like affinity like aren't moving faster to create more like financial products for their customers, because they would crush it, right? And I think like that is starting to happen. You're starting to see a lot of these companies really start to like create their own like financial product suites, and that will only continue to grow.
Yeah, very interesting. I like that. It's almost like, what's old is new again. A lot of credit unions started that way, right? Like a common membership goal and create financial services geared towards them. So that could be an interesting take. Cool. Well, thank you all for the time. Really enjoyed the session and the chat today. So hope you enjoy the rest of the show.
Thank you.
Awesome.
Appreciate it.
Thanks for having us.